Oh, hey there. Today I think we need to discuss the importance for all of us to understand what is going on right now in the financial markets and how it can either destroy us or how we can thrive from it. So in today's video, it's all about the flow of money, how money is created, how it's destroyed, and the role that you personally and I personally play in all of this. I hope you guys are ready. Let's get into it. Well, hey everybody, welcome to my channel where we talk everything real estate, investing, money, finance, and more. I'm your host, Tim, and today, like I said, I wanted to get into the flow of money on Wall Street. I want to talk to you about the old banking system, which is one that I think we all understand, but I want to also show you the new banking system and how it compares to the old banking system. Okay, I think once we get an understanding of the basic flow of money on Wall Street and through the economy, then we'll understand why this deleverage cycle can either be the opportunity of a lifetime or the demise of so many people. All right, guys, so as you know, I'm a very visual person. I got a chart here. Let me see if I can put myself somewhere where I won't be quite covered by it. All right, there we go. So this is the old banking system. Over here, we have Saving Sally. Now, Saving Sally has spent the last, let's say, year saving up, and she's done a good job. And Saving Sally now has $20,000 in her savings account. But she doesn't want to keep that at home. So what does she do? Well, she happens to have a bank account at Wells Fargo. So she takes her $20,000 and puts it into a deposit with Wells. Where Wells Fargo probably says to her something like this. Hey, you know, you're going to give us 20 grand and we'll go ahead and give you a generous 1.5% while you leave it in here with us. How's that for, you know, an incentive? And that's incentivizing, because why would you want to have it just at home where it's not protected or insured while they're willing to insure it and to still maybe give you some additional profit for being in there. Now, Wells now has $20,000, but they don't want $20,000 because to a bank, cash is actually a liability to them, because it now means that their liability is Saving Sally. So what does Wells Fargo do to solve the problem? They take $20,000 and they go, hey, anyone in the market looking for $20,000 that they can borrow, or that they want to borrow? And along comes Builder Bob. And Builder Bob says, hey, the real estate market's been on fire. I want to start my own company. I need $20,000 for starting my own company. That's how much I'm short. He goes to Wells Fargo and Wells says, good news. I have $20,000 just for you, Bob. As a matter of fact, I'm willing to give that to you at a really good interest rate of 7%. Right? Now here's the best part. The bank's profit is the difference between the 7% and the 1.5% that they're paying Sally. That is the old banking system. All right, so that's a little bit about the old banking system, which was really complex. So thanks, government. They came up with a totally new banking system that's so much easier to understand. Let me show you exactly what I mean. All right, here you have Wells Fargo. Banks like Wells Fargo, I put Wells Fargo and others. That's going to be Bank of America, Chase, anyone that you bank with deposits. Normally these are FDIC insured, or they could be credit unions that have another type of insurance and they take deposits. Okay, you have your rich uncle here, the Fed, and they're really the ones that control the market. Although they are not a bank, they are not a depository bank. That's a big thing to understand. They're not a depository bank, which means they have no money. They have a balance sheet. It's much different. Okay, then you have the U.S. Treasury, and they're the ones who have the ability to tell the Fed, or I should say, not tell the Fed to print money, but they do have to. They tell the Fed they tell the Fed to print money, and let me show you how. It has to do with debts. All of our money in the country is built on debts. Since a lot of people got mortgages from me or car loans from me in the past, let me just show you very simply. with a very dummy down, small situation on a very small scale, because we're about to get into something much bigger with deleveraging. Okay, you have Tim over here. He's a 19-year-old kid and just got a job and he wants to buy a car. I'm not good at drawing cars. And then a door and then maybe a window. All right, so he wants to buy a car. The car is going to cost him $10,000, but he doesn't have the $10,000. So he has to go to a bank. He goes to Wells Fargo and he goes for a loan for $10,000. You'd think that what Wells does is takes the deposits that they have and loans them out, but that's not what they do. Instead, what Wells Fargo does is they go and they get a warehouse line from the Federal Reserve, who, by the way, like I said, has absolutely no deposits, and they fund the $10,000 loan from the Federal Reserve. So, here's the part to understand that's important. The money didn't exist until the loan was taken out, okay? So Tim needs a loan to buy a car so he can get to and from work. The car loan needs to be 10 grand. Tim goes to the bank to get the loan from Wells Fargo. Wells Fargo approves him after underwriting him and says, yeah, we'll give him the 10 grand. At that point, they go back and sell it to the Federal Reserve, and that goes on their balance sheet as an asset, okay? That money has been now printed into existence, okay? That's on a small scale. So then people would say to me, Tim, that makes sense. That all makes sense. On a small scale, that makes total sense. However, we just went through this area where all they did was Treasury went in and said, hey, everybody gets $1,400 checks. Who cares? We're just going to throw out $1,400 checks. We're not going to target it. We're just going to throw money out blindly. That doesn't even sound like it's going to end well, does it? No, it doesn't to me. It makes no sense. But it does tell a lot of people, and I'm hoping that this video reaches more and more people. By the way, if you want it to reach more and more people, can you do me a favor and hit that little like button, and then there's like a subscribe thing, and then I think there's a notification bell. That way it lets YouTube know that this is good information to get out, hopefully to help other people that might not, we don't want people to go into debt. Okay, so back to where are we with the Treasury and sending out these $1,400 checks, as much as 7 grand some of these families were getting, okay? So, let me put myself back in a place here. So here's how that went. Like I said, the Treasury didn't have the ability to print money. Here's where we go on the bigger scale. Instead of the car loan scenario, you now have the U.S. Treasury saying, hey, we need a loan. Okay? And in order to get a loan, we need what? I don't know. I think they spent, I don't know what it was, but 1.9 trillion. God, that's just so big. 1.9 trillion with a T. I had no idea whenever I was a kid. I was like, millionaire, super cool. And then whenever I heard the word billionaire, I was like, whoa. And then when I heard the word trillionaire, I thought that's the magic number because my name starts with T. So anyway, we have $1.9 trillion they want to borrow. Well, what do? They go to their uncle, their rich uncle, the Fed, and says, hey, I need to borrow $1.9 trillion. Hey, no problem. The Fed says, here you go. We're going to print you $1.9 trillion. And they take that $1.9 trillion, and here's where it gets interesting. They just went ahead and deployed it into the market blindly, every which way. Let me show you what I mean. Over here on the left, we have working, I don't know, we'll call her working Heidi, along with her hardworking husband, Mark, okay? Mark and Heidi are hardworking. In fact, Heidi helps every time Heidi happens to do something at her job where she's successful, she helps 7 other people earn money. Mark does something at his job where every time he helps somebody, they heal because he's a doctor. They have a couple of kids, and they're spending their money raising the kids. And so this is kind of your normal situation in the U.S., right? Then you have another situation here in the U.S., which is when you have your family here, and maybe this family isn't working, and they got a lot of children, so they decided to stay home and raise their children. But keep in mind, they're not producing, okay, not producing, and this is important to understand why them not producing affects you and me and everybody else in the world out there, okay? By them not producing anything, they're gonna get the most money. They got $7,000. Well, where did that $7,000 come from? Well, I'll tell you what, the Treasury took a loan from the Fed and then gave it to everybody, right? But they're gonna convince the Congress, oh God, I'm getting mad. Are you guys ready for this? I'm just gonna draw it out big right there. They're gonna get the Congress to come after us for taxes. And I'm talking about everybody. They're coming for us all. That's fine. I'm up on my taxes. I'm sure all of you are too. They're gonna probably waste their money with what they're talking about going after billionaires. There's no way they're gonna be able to do that. But that's the flow of money on Wall Street. So let's recap real quick. You have somebody who needs to borrow money, and they're going to use an institution such as a bank. At the end of the night, that bank is going to settle up with the Federal Reserve. The end of the night, when the banks settle up with the Federal Reserve, the Federal Reserve is going to work overnight, over our night in the US, with other banks in other countries in the UK and stuff like that. They have reverse repo windows and things of that nature that they need to keep very active in the market behind the scenes when we're sleeping. But during our open hours, these are the kind of things, this is exactly how the flow of money, dollars, works in the US now. I'd like to get back to a point where it didn't. But what does that bring us to next? Like I said, we got to talk about the deleverage cycle. I believe that deleveraging cycle is finally here. And here, let's talk about what is a deleveraging cycle. Let's get into that on a macroeconomic scale. I want to read you the exact definition, and here it is. At the macroeconomic level, deleveraging of an economy refers to the simultaneous reduction of debt levels in multiple sectors, including private and government sectors. It's usually measured by a decline in the total debt to GDP ratio in the national accounts. Guys, our debt to GDP ratio right now is through the roof. As a matter of fact, as you can see here, the debt of the United States GDP ratio is 134%. Okay, let me explain what that means. If you got somebody working at McDonald's and they're bringing home $2,000 a month, that they're bringing home after they pay taxes, $2,000 a month, and then they have a rent payment of $1,000, and then they have a car payment of $500. Maybe they have two car payments, one for $250 each, totaling $500. And now they have a grocery bill for their 2 or 3 kids of $600. What happened? They brought in, well, how much? They brought in $2,000. And how much went out? Well, they spent, let's add it up, 1,000 plus 500 for the car payments, plus 600 for the food. And we didn't even get into the insurance that they needed for the cars, or the gas, or maybe diapers, or other necessities. We're just talking about like just the basics, right? Now, that would represent a $200 deficit. Now, they may go into credit card debt. So if they're going into credit card debt, what are they really effectively doing, right? They're stealing purchasing power from their future, and they're spending it now. That's all that debt is. And I know that they have this new thing out there called monetary money theory or something like that, where they believe this system works, that you can just infinitely print money. As a matter of fact, last night, the Bank of New England did just that. Other countries are doing nutty things just like that, and it's going to crash the market whenever the deleveraging cycle finally comes. But when it comes, guys, be ready. I want you to have lots of cash in hand. If you need to borrow while you can, because as soon as the money gets tighter, as the money flow gets tighter, as the Fed starts tightening monetary policy and keeps on going, they're pulling back, they're extracting money out of the system. Get some of that money because the opportunity of a lifetime is coming soon. Oh gosh, this is an exciting day for me, exciting video, guys. Thanks for tuning in and watching. Hope that you got something out of it. Hope that you enjoyed my perspective. If you did, consider liking, sharing, subscribing. We'll see you in the next one, folks.